The 4% Rule: How to Achieve Financial Independence. Navigating the vast world of retirement planning can often feel like charting a course through uncharted waters. The 4% Rule guideline consistently garners attention among the myriad strategies financial planners endorse, for a good reason. It's been tried and tested against the volatile returns of market history, guiding retirees toward a balanced and strategic withdrawal plan. The 4% Rule, often called the Safe Withdrawal Rate, SWR, originates from a study conducted in the 1990s by financial planner William Bengen. The rule suggests that if you withdraw 4% of your retirement savings during the first year and adjust that amount every subsequent year for inflation, your savings should last 30 years. Let's break this down using a simple example. Imagine you have a retirement portfolio of $1 million. You'd withdraw 4% of that in the first year of retirement, or $40,000. Each subsequent year, you'd adjust the $40,000 for inflation. For example, if inflation were 2%, you'd withdraw $40,800 the following year. The 4% Rule's foundation is based on historical data regarding the performance of financial markets, especially in the US. When William Bengen conducted his research that eventually led to the formulation of the 4% Rule, he made certain assumptions about the composition of the retiree's investment portfolio. Specifically, he looked at portfolios with 50% stocks and 50% bonds. Here's a brief explanation of why this specific allocation was used and its significance. A 50-50 split between stocks and bonds balances the growth potential of stocks and the relative safety and stability. Over the long term, stocks have historically provided higher returns than bonds, but they also come with higher volatility. Bonds, on the other hand, tend to offer more stable but lower returns. Bengen's research considered the worst-case scenarios in market history. He wanted to determine a withdrawal rate that would have worked even during the most challenging periods in financial market history. Using a 50-50 portfolio, Bengen ensured that even during prolonged stock market downturns, the more stable bond component could provide a cushion. This mix diversifies the portfolio across different asset classes, thus spreading and potentially reducing risk. If one asset class performs poorly, for example stocks during a market downturn, the other asset class might provide some stability, for example bonds might hold their value or not drop as significantly. With a 50-50 portfolio, retirees could regularly rebalance their investments. For instance, if stocks perform exceptionally well in a given year and now represent 60% of the portfolio, the retiree could sell some stocks and buy bonds to return to the 50-50 allocation. However, it's essential to note that while the 4% Rule was based on a 50% stock and 50% bond portfolio, it doesn't mean such an allocation is optimal for everyone. Individual risk tolerance, financial needs, market conditions, and retirement goals can all influence the ideal asset allocation for any person. The 4% Rule assumes a mix of 50% stocks and 50% bonds in your investment portfolio, and it's based on historical data about how markets have performed over lengthy periods. How the 4% Rule can guide you to achieve financial independence. First, you need to know how much you anticipate spending each year in retirement. Let's say you decide you'll need $40,000 annually. To determine how much you need to save, divide your annual spending by 4%. Using our example, $40,000 divided by 0.04 equals $1 million. So, you'd need a $1 million portfolio to support a $40,000 annual withdrawal under the 4% Rule. Once you know your target portfolio size, you can work backward to determine how much you need to save and invest each month, considering an expected return on your investments. The journey to financial independence is not set in stone. It's essential to revisit your numbers and adjust for changes in spending, investment returns, and any other factors that could impact your financial needs or the growth of your portfolio. Here are some limitations and considerations. The 4% Rule is based on past market conditions. If you live longer than 30 years after retirement or retire early, you might need to consider a lower withdrawal rate to ensure your money lasts. It's essential to be flexible in your spending. The rule doesn't account for other income sources like Social Security, pensions, or part-time work in retirement. Understanding the principles of the 4% rule is crucial for those aiming for financial independence. This guideline is about marrying past market data with a balanced investment strategy, ensuring that retirees have a fighting chance against market downturns and longevity. However, while it lays down a sturdy framework, achieving true financial peace might require personalizing the rule based on individual nuances and the ever-evolving financial landscape. The 4% rule is a helpful guideline for those looking to achieve financial independence. However, individual circumstances vary, and it's always recommended to consult with a certified financial planner to ensure your retirement strategy is tailored to your unique needs.